Hello, this is Rick Cortez. I'm CEO of Broadmark Asset Management, and this is the June 2024 update on the Westwood Broadmark Tactical Growth Strategy. And today I'd like to highlight the most recent model changes we have made. We have a 55% exposure to the market, but what we have done is we have diversified that exposure and added two sectors, healthcare and utilities. These are defensive sectors, and we've done this to diversify the portfolio. And the reason for this is we are still seeing a divergence between the fundamentals and momentum. On the fundamental side, valuations are high by historical standards. The Fed has kept interest rates a bit higher for a bit longer than people expected, and that seems to be biting into the economy right now. At least we're seeing some indication that that's true. And finally, investor sentiment is overly optimistic. In fact, we are seeing some real speculation in meme stocks. And of course, there's that huge concentration in the tech and AI areas. So these divergences exist. Has this happened before? And the answer is yes. Take a look at this slide. This slide shows the weighting of the top 10 stocks in the S&P 500 going back to the 1970s. And as we can see, in 1972, at the height of the Nifty 50 mania, this percentage got to 34%. So 34% of the S&P 500 was in 10 stocks. This led to a bear market and a 50% decline in the market. The percentage came down into the 90s, but then started rising in the late 90s during the dot-com era. And in March of 2000, this percentage topped out at 26%. And again, this was followed by a bear market and a 50% decline in the stock market. The percentage declined into 2015, but in the last decade, this concentration has been increasing. And right now, we find ourselves right back to where we were in 1972 with a 34% concentration in the S&P 500 of the 10 top stocks, largely AI and tech stocks. We don't have a crystal ball. As you well know, we do not predict the market. We adapt to changing market conditions. Our goal is simple. We are an absolute return manager. We want to make a positive return every year. We've done so in 18 of the last 22 years. And most importantly, we were up in 2002 and 2008, two huge bear market years, and we sidestepped the decline in 2020 during the pandemic. We see a number of geopolitical risks. We're in an election year right now. And with these divergences and concentration, we would suggest that perhaps a non-correlated strategy like the Westwood Broadmark Tactical Growth Strategy might be appropriate now. We offer low volatility, low correlation. And again, those of you who know us know we can act as a very effective shock absorber for the portfolio. So this is Rick Cortez. Thank you so much for joining me. Please join me next month for the next update. Thank you.